All right, we're ready to get started. Thank you guys for tuning in to another Sunday night stock market scan. I think my mic is on. We're good. We're off to the races. Been a couple of weeks since we've been able to have a weekly stream, so a lot to talk about tonight as far as recapping what we've done the last few weeks and game planning, of course, for the coming week. Talking about, yes, we've made some money in the past few weeks, but most importantly, how are we going to use our strategies and how are we going to game plan to make more money from here on forward, which I'm sure is what you guys are far more interested in. But without further ado, as always, we've got the giveaway. Another quick announcement at the top of it. If we get 30 live viewers during the stream, and if we go to this presentation, boom, it's over there. If we hit 30 in the stream at any point, we're going to give away one of these handy dandy HT Yeti tumblers. How cool would you be with one of these? I mean, does not get much better than that, let me tell you. Ted, if you're watching this, I still need to send you one, so keep an eye on that. I have not forgotten it. But without further ado, so I do not keep talking in circles and distract from what we're trying to do here, let's get into it. So last week, the week of April the 30th, we took home a profit of $358. Again, not a massive amount, but the most important thing about the money that we made last week was that we did it on a week when the S&P 500 was down 0.79%. And our overall goal in all of this is simply outperforming the market. We've done a very good job of it over the past coming up on 3 years that we have been publicly doing this and tracking our trades and trading with you and talking with you all. So we've been doing this for a decent bit of time thus far. Maybe in year one you get a little bit unconfident about, is this something that we're going to be able to continue? Are we going to be able to continue to have this kind of success? We've had a couple speed bumps along the way that you could definitely see in this chart, but overall we are crushing NASDAQ, we are crushing the S&P 500, and we're going to try to keep doing that. But again, at the end of the day, I've always said that even if we only make $358 in a week, if we are green at all on a week where the market overall is red, that is a huge, huge accomplishment. And that is how you're going to have long term success. It's not about crushing it one week and, oh no, we give it back the next. Just not taking steps backwards and just continuing to build on what we have. And I think we've done a very good job of that. Taking a little bit of a step back since we haven't talked in a couple weeks. Here's our performance year to date. This is this upcoming week, so that doesn't count. But we have wrapped up 8 weeks in a row where we have made money, and I can guarantee you that the market was not up all 8 of those weeks. And over that period, we've made $8,248. So again, the whole theme of 2023, the way that we've set things up, is to avoid taking steps backwards. And we have really done that. We've only had one bad week where we dropped $3,700, and that was a week when the market dropped 4.5 to 5% between the S&P 500 and NASDAQ. So maybe a little understandable there, but we quickly recovered that and are just slowly building. This profit curve, while there was one annoying week in there, this is so much lower stress. We're over a 10% return when we're not even halfway through the year yet. We are slightly underperforming NASDAQ. We're outperforming the S&P 500, but again, a lot of the money that we make and the outperformance that we get comes when the market pulls back. And we quite frankly have not seen a lot of that so far this year. Really, the only examples you could see were in February when the market dropped 3.87% and we still made $1,400, and that's evidenced by these pullbacks in NASDAQ and the S&P 500. But other than that, things have been smooth sailing. And if the market is smooth sailing and we perform with the market, I'm perfectly happy with that because it means we're going to keep making money. But the question I get a lot, especially in stretches like this when the market keeps going up, is, hey, what happens to our strategy when the market goes down? Are we dependent upon the market going up? And the answer is no. From an outperformance perspective, we make up more ground against the market when it does go down. So that's something important to keep in the back of our mind. And you may get impatient, as we had a week where we made $358 and then a week where we made $142. So a 2 week stretch where we took home exactly $500 after commission, excuse me. Stretches like that, you may get a little bit impatient, but take a look at the bigger picture, right? Over these last 8 weeks, that's $8,200. What we want to avoid are the red weeks, and we've done a great job of doing that up to this point. So, we could quickly talk a little bit about what happened last week. And the best part about this is we had some stuff go really, really far against us, right? Peloton started the week at $8.98. It finished the week at about $7.50, or at least that's what it was trading at when we rolled our positions. So if you look at that, that's 8.98 minus 7.5. That's a $1.48 drop off an 898 stock. Peloton dropped 16.4% against us. And yet, even though it was a $740 loss on the stock, we could zoom in one more click if this is helpful. Even though it was a $740 stock, we sold 9 strike calls off the bat. And our break-even price was going to be, 898 minus 0.73. It was 8.25. But then after it dropped, we said, okay, we've got to play a little bit of defense. So we started with that half-size position, right? The 500 shares, with knowledge that we could, if we needed to, double down by selling more cash secured puts. So when we had 500 shares, we'd want to sell 5 cash secured puts. So you see those shares here. We bank out the profit on the 9 strike call, and I could pull the chart up here to make this a little bit more intuitive, and you can kind of follow the flow of it over the past 5 days. But boom, here's this huge earnings driven dive. So once it fell back down, we had a pretty good idea that this thing wasn't going to get back up to 9. So what do? We close the 9 out for a profit, and we go into the 8. And while it's not a ton, right, we only got $70 of profit off this. Every little bit counts. So we rolled these down for a 13-cent credit, meaning that we closed the 9 strike calls for 3 cents. We opened the 8 strike calls for 16 cents. So we received 13 cents more to open the new ones than we did to close the old ones. I think I may have said that wrong, but there's a 13-cent difference here. That's what we're banking on, right? So if we pull up that handy dandy system calculator again, we know that we started with the stock at 898. We sold covered calls for 73 cents. Boom. It was an 825 break-even price going into earnings. As happens often in the market, things moved against us. That's going to happen. What's your contingency plan? So if we go back to what we did and pull the calculator up again, we rolled down for a 13-cent credit. So that 13-cent credit is a direct reduction of our break-even price. Now we're sitting with an 812 break-even price. However, you'll notice that the strike of our covered call is 8. So we actually can't get to 812 to fully break even. So what do? We double down. This is where the double down is very, very effective, and you'll be able to see it right here in these figures. So by doubling down and creating an equal sized position with the 7.5 strike puts, every cent of premium that we received on those 7.5 strike puts is a direct reduction of our cost basis. So our cost basis, in conjunction with rolling down to the 8 strike covered calls, which got us to 812, selling these 7.5 strike puts, these cash secured puts, dropped it 31 cents. So we're now sitting at a 781 break-even price, which we're very, very happy with, right? We started with an 825 break-even price. Hell, the stock was at 898 to start the week up here, and we finished the week with the break-even price down here. And now it did get back up there by end of day. However, it was a little bit below 750 on the back end of Friday, so we did roll that position a little bit early. But big picture, even though we lost 740 on the shares, those initial covered calls made back 350. The covered calls we rolled to made back 70. And those 7.5 strike puts that we sold made back 115. So even though it was a $740 loss on these shares, it was only a $205 loss on Peloton, despite the fact that it moved down 16% on us. And again, we talk about these losers a lot because being able to manage the losers like this is how you consistently find these winning weeks. Because there are a lot of trades on this list that win in our favor. We don't really need to talk too much about them. But the ones that move against you are going to be the most pivotal ones in determining whether or not your week is profitable week or a losing week. And again, while these options that we sell have set expiration dates like May 5th, we can roll them into the following week. So if you look at what we have set up for next week, we still have these shares. We sold a 7.5 strike call. We sold 7 strike puts. So we have a similar position size into next week. And yes, we lost 205 on it last week, but look at this. If Peloton finishes above 750, which it's currently at 781, we can look at the chart. It finished at 781 on Friday. We're going to make 159 from the covered calls. We're going to make 95 from the 7 strike puts, and we're going to have an overall profit of $85. And again, the point here isn't that $85 is just this huge profit that's going to put you over the top. However, the point here is the fact that we had a stock that, again, started at 898 just last week. This is a 5-day period that we're looking at here. Started at 898, and now we are going to make money on this thing so long as it finishes above here at 750. So that's fantastic, and that's a great example of how we can use option premium to our advantage and continue to roll these things week after week. And if you could turn your losers into just not even winners, but just break even or around break even trades, it's going to be great from a long-term performance perspective, as your winning trades are going to carry you. So speaking of winning trades, here are a few of those. For example, SPXU was a hedge, but we made 180 bucks on it. Wish the 7 strike puts, we closed them early for profit, and it's a good thing that we did. But again, that's 110 bucks. Zscaler ticker ZS, quick 140 right there. These meta call credit spreads made us 158. CLF we opened on either Thursday afternoon or Friday morning. I forgot which one, but 115 right there. These XSP 417 strike calls. But again, you kind of see how this works, right? These $823 of profit just right there off stocks that, went without much of a hitch. And that's despite the fact that the market was red. So we've got all these. We talk a little bit about Peloton because it's important to understand how to game plan and how to manage the losers. But there are a lot of winners on a week-to-week basis. With these strategies we're using, we are going to win a lot. But the most important thing from an option selling perspective is making sure that you limit the magnitude of the losers, and that is how you do it. Unity is another great example right here. We had these 26.5 strike puts, and this is a situation where we maybe feel a little bit of regret, and I'll tell you why at the end, but I'll also tell you why it's not that big of a deal either. But we sold the 26.5 strike puts. We go to the Unity 5-day chart. You're going to see that it fell off the face of the earth, right? This thing went from above 27 and at the bottom got to 24.66. So when that happens to us, our hands are kind of tied. We have to play defense and do something. So what we did was roll 26.5 down to 25.5. And you'll notice we did it for a debit. However, what we'll see right here if I pull the calculator back up, why did we do this for a debit? Because it's all about that break-even price. On a 26.5 strike put that we sell for 75 cents of credit, we have a 25.75 break-even price. However, if we roll to a strike that has a little bit more extrinsic value, we're going to get a lower break-even price than 25.75. So what you'll notice is that even though we rolled for a debit of, let's see what this debit was. I'm going to have to do some math here. 1.63 minus 0.85. It was a 78-cent debit. So we went from having, I can pull up the history, our 25.75 break-even. Let me get this out of there. 25.75, and we said we had a debit of what? 78 cents. So a debit raises your break-even price. So why is that not entering? There we go. So it's 26.53. However, rolling down a strike from 26.5 to 25.5 is also a direct reduction of $1. So all in all, even though we rolled down for a debit, our break-even price actually decreased from 25.75 to 25.53. But now what do we know about 25.53 on a 25.5 strike put? We're probably not going to be able to make any decent cash there. So what did we do? We averaged down. We doubled the position. Just like we did with Peloton when it moved a little bit too far against us, we did the same thing with Unity. And since we have a 3-size position, we had 3 more for 41 cents. That 41 cents is a cent for cent reduction of our break-even price to get us down to 25.12. So in one quick move, we go from having a 25.75 break-even price, which is right here, to getting down to 25.12, which is all the way down here. And while that may not be a ton, on a 5-day basis, one, this is pretty volatile activity, but two, what you'll see is that, even just moving your break-even price, this red line from here to here, that's enough to, really contain a decently sized move. This thing had a range of about 10%, right? A $2.50 range on a $25 stock. That's about a 10% range. Yet despite that, we were able to manage the position in such a way that it managed it. So yes, it did go back up to 26.5. So this is where the regret pops in. If we just held the original position, we would have been fine. But we never necessarily want to bank on a huge move in our favor. We always want to be playing the what if this thing gets worse game, because it can and it will get worse at some point. So we always want to be prepared for that. While this is a little bit more conservative and it puts us in a position where we couldn't recover that big move back to 26.5, what it did do was make it so we could absorb a further move down. And again, making sure your losers aren't that large of magnitude is the name of the game. And even though this did move against us, we still, even though we lost 264 in the first position, we made back 192 on what we rolled to. And then what we doubled down on, we made 123. So it was a $51 profit. Which again, the point here isn't that $51 is a ton of money, but the point is this is a trade that moved against us, yet we still made money. If you could have your losers make you money, you are going to do very, very well. I probably sound like a broken record from saying that, but I think it is it's a point that definitely bears repeating. Moving down to Affirm, I mean, you've got the same exact thing, right? We sold a 10-strike put. And I think if you take a look at Affirm, this is very similar because it went up like 15 to 20%. But at one point, this thing got down to $8.08. Yet, despite the fact that it went, a dollar below our original strike, over a dollar below the original strike, our original position lost money, and then the new position made money, $5 profit. Hands off. We're not going to complain about a green result on a red move. So the only other thing I guess worth talking about potentially is this Wish 7 strike put. We made 110 bucks on this, but Wish finished the week. Where did it finish the week? At 747. Never mind. It would have hit max profit. But the point I want to make here is Friday morning, it was pretty low. It was at 640. So this thing would have been worth at one point about 0.6. And we knew that Thursday night earnings were coming. We didn't necessarily want to take that risk. If you've got something where you could take about 50% of max profit, and that's about what we're looking at here, if you could take that max profit and get out of it without having to incur the risk of earnings, you're going to be in a very, very good position overall. So that's what we did, and that was the week. That was our $358 profit. Nothing crazy, but again, anytime you could be pulling, the market is going down, you're going to be successful long term as an investor. So without further ado, let's get into this upcoming week. And the way we like to evaluate these weeks, if you're new on the stream, if you watch us every week, first off, thank you very much, but apologies because this is going to be a little bit repetitive. What we do is we like to evaluate our positions based off what's called base profit. And what base profit is what's showing here in our spreadsheet. So if the market were somehow to be closed for the next week, or a better way to think about it is that if the stocks don't move a single cent, right? They finish Friday afternoon where they currently are right now. This is the amount of money that we would make. And as option sellers, that's the great part about the game we play, right? If nothing happens in the market, we make money. If things move in our direction, we make money. If things move slightly against us, we can manage them and still make money. The only thing that really, really hurts is if something moves very, very far against us, which can happen. I'm not naive to think that, but we want to be smart about our position sizing, which we are. 24.88%, meaning we could double down on this portfolio not once, but twice, and still be able to afford it on a fully cash secured basis. Having cash on the side is flexibility in a market like this, and we do have a volatile event coming up. I believe CPI for April is being released on May 10th at 8:30 in the morning. So that's Tuesday morning CPI. Now with that said, I probably want to take off this XSP strangle now that I think about it. We want to avoid things like FOMC where there are rate hike announcements. We want to avoid potentially volatile events like CPI. I'm probably going to take this one off the board come Monday morning just to take a little bit of risk off. But in general, if nothing happens, we're going to be hitting a 1% return, which is our goal on a week-to-week basis. We haven't hit it the last few weeks, but it's a goal, right? If you hit it, success. If you fall even a little bit short, you could still be successful, which is what we considered last week. But top to bottom, let's talk about what we have. We have Macy's 15.5 strike puts. Macy's is one that moved against us big time last week and was looking at like a $5,000-ish loss at one point, but we scaled in twice. We're gradually scaled in. We gradually scaled out of the trade, and now what we're left with is a position right about here, which will make 150 more bucks back if it finishes above that level. It's not too much to talk about there. Peloton, this is a continuation of the trade that we talked about at the top of the stream. So again, break-even price there is like $6.98, right? I think if it goes down to $6.98, we end up close enough. It's actually $6.97 or $6.96. Either way, our break-even's below $7 a share, so we have a cushion of over 10% on Peloton for the coming week. They already announced earnings. I'm comfortable with Peloton in this price range, so I think this is a good place to be. Zscaler, we're going right back in, right? This is a trade we had from last week. We sold the 86 strike put for $1.40, so we bagged 140 bucks of profit on that one. This week we're going right back into the 86 strike put. Why are we doing that? The answer is because it came up in our oversold scanner. And while it did kind of go back up with the rest of everything on Friday, on a one-year basis, still pretty oversold at 31.5. And again, this is exactly what we like to see. Implied volatility came up a little bit. You've got a stock leveling out down here. When it gets below 30, that is when we want to pounce with bullish positions. And I think the old oversold scan that we've been using has probably been one of our best money makers on the year so far in identifying opportunities like this. Because if we quickly run the scan, go to the option hacker, high ROR puts without earnings, intersect with oversold stocks, hit scan. This list that this thing comes up with, it takes like 20 seconds to pull this up. And the stocks that we've been getting off here have been very, very good to us. So here it is. We'll look at this in a minute and maybe try to game plan a little bit further. But that's where that Z-scaler position initially came from. Now, as far as what we like to do, when it dips like this, you could definitely expect a little bit of not even necessarily a bounce. We don't need a bounce. We love a bounce. But even if it just levels out a little bit, that's enough for you to collect the extrinsic value on the options that you're selling. I'm potentially a little bit hesitant because it, bounced already. It's above 30, but 31 is still pretty low. If we go to the 5-day chart, it fell back a little bit end of day Friday. So from an entry perspective, that seemed okay. And it was pretty sticky right here in this 86-ish level. So selling the 86 strike puts for next week for $1.06 means that our break-even price is going to be $84.94 and literally a cent off of the low from last week. So I think objectively probably still a good place for us to be on that one. And as always, that's a half-size position. We can afford to double down into that if need be. Next one on the list is going to be Penn. I definitely wanted to get back into the gambling sector. Ever since DraftKings kind of ran away from us, RIP. This trade was my baby. That took us over an entire year. It dropped 63% on us, and we still came out on top with $1,000 of profit. It's probably the hardest $1,000 I've ever made, but it is what it is. But ever since that ran away, I've been trying to find a way to get back in. Penn Gaming seems like it's in a great spot for us to do that right now. If we go to PENN, again, we talk about this oversold idea. It's not quite at 30. However, what you'll notice is on a 1-year basis, a little bit less erratic of a trading range. Can it dip below this and continue to fall? Absolutely. I think back during COVID, it was really, really low at one point. I think it bottomed out at 4 just because they didn't know if the company would be able to continue. But there's definitely this idea of support here at this 26 level that's very easily observable. And if we go back to that 1-year chart, you'll see it 25.49 is the low. But if you could draw that line in there at 26, it looks, where is it? Where's the 26 line? It looks very, very nice. It's bounced off it once, twice, 3 times, 4 times here if you count the bottom of that wick. But I'm happy to initiate a position in Penn at 26 strike. And with the 60-cent premium, only selling 3 of those contracts. 1, we're only using 3.94% of our account. We could definitely double down on that one. But 2, if it finishes above 26 next week, we're going to make $180. And top to bottom, that's the idea of the strategy, right? No single trade here is going to make us $3,000 and, make or break the week, because it could also lose $3,000. We want a bunch of smaller, smarter trades that, compound on one another to give us a generally successful week overall. Next one is Unity. This one, definitely be aware of this one because it has earnings for the coming week. But in response to that, we're going to play it very similarly to how we played Peloton, right? We'll remember that we had Peloton at $8.98 a share. It dipped down below $7.50 a share at one point last week, and yet we're still in a position where even though we lost $2.05 last week, what we rolled into this week will make us money overall. So we're taking a very, very similar approach by jumping in on some 23 strike puts, which we sold for 73 cents. We pull up the Unity chart. Here's the 1-year chart, right? We know that if we sell a 23 strike put for 73 cents, that's $22.27 break-even price. So that's very, very far down there. It's just above the 1-year low. So I'm very, very comfortable with this as an ownership spot. And if it dips down below this, guess what? We're only in a half-size position. This position represents 3.45% of our account. So we could very easily double down there, and we'll take advantage of the volatility of earnings because, 1, if it moves our way, it's going to be a very, very easy $219 of profit. 2, if nothing really happens and it doesn't drop 15.84%, which is our cushion, we're also going to make that money. And then 3, if it does drop over 15% on a 1-year basis, this is one that looks like a decent entry point. I'd be happy to own it and scale in this low 20s area on Unity. So that's the idea. If it moves in our favor, we're making money, but it's a win-win situation because if it does not move in our favor, guess what? We're getting a stock at a very, very favorable basis and using that opportunity to scale in using the idea of RSI where, look, right now it's at 42.07, but if it drops down to 22.21 next week, you better believe this is going to be firmly in the blue section. And we know every time that we see something go into the blue normally on a 1-year basis, pops back up pretty significantly. So we want to take those dips as an opportunity to load up and then try to catch the rip on the other end of it. But that's the idea there. SPXU, we're keeping this one running for another week. This is a bearish ETF. So if the S&P 500 goes down, this goes up. We've got upside to 13.5 on here. So at most, if the market completely tanks this week or just slightly goes down, is red at all, we're going to make $230 back on it. And what you'll notice here is we've got a few more bearish positions. In fact, what I really want to point out here in game planning is we talk about RSI bonds. Let's talk about the overall market. The S&P 500 ETF SPY is at 54.92, so slightly overbought after what happened on Friday. So with that said, do we want to be more bearish? Do we want to be more bullish? I propose at 54, anywhere around 50, we kind of want to be in between. While generally we like to be bullish overall because the closest thing to a guarantee in the market is that it's going to go up in the long run. But at 54, it's a little bit above that 50 mark. So what we have is kind of a balanced portfolio. If you sum up all the profit, the base profit from our bullish positions, you get 1,080. If you sum up the base profit from our bearish positions, you get 513. But again, if the market goes down, this hits 13.5. Shake Shack goes down, this hits 0. All of a sudden, you're looking at a very similar number, 845 on the bearish side. And then we have 280 of neutral, which we're probably going to exit on Monday morning. But the idea here is that we're definitely a little bit more balanced than we normally are. And let's talk about the 3 bearish trades outside of the SPXU trade that we've entered into to try to take advantage of some overheated stocks. Because again, on Friday alone, the market was up 1.85%. While we really, really like to lean heavily on the 1-year RSI, if we go to maybe the 20-day, it's very, very red off this huge rip. And again, anytime you see this red, it typically falls back down a little bit, right? It cools off a little bit, and that's never to say that it's not going to move higher. But typically, the market's got to cool off a little bit. We're not quite seeing it on the 1 day, but on a shorter trend, maybe even on the 180 day, not quite 58. But it's definitely running a little bit hot. So the idea there is let's go to our scan and let's find some stocks individually where the S&P 500 on a 1-year basis may be at 54.92, but we could find some individual stocks that are also running a little hot. So good question in the Twitch chat. What's our Shake Shack position? We'll go top to bottom here. We'll talk about TGTX, Shack, and RCL and where we found these. So if we go to our scan and not oversold stocks, but we go to HT overbought stocks, what it's going to do is come up with a really, really nice list here for us of stocks where we talk about this 1-year RSI at 54 on the S&P 500. Let's find some individual stocks that are above 70. That's exactly what this scan is going to do for us. And what you see here is TGTX, Shack's off of it because it dipped a little bit, and then RCL, Royal Caribbean Group. So we start with TGTX. And again, the great part about this is you could quickly, analyze some of these when you have this RSI column saying, okay, TGTX, this is the one that is the most overbought. And then if we sort these, we'll say, okay, and then Shopify is more overbought, and then, et cetera, on and on. And these are really the only options here that provide decent premium and that combination of overbought RSI. So if we go to TGTX, what you'll see here is you might say HT. This looks a lot like a stock that we never necessarily want to touch. And I think you would be right. However, we're looking at 84.19 RSI. That is out of this world, quite frankly. And the great part about this, if we sell a cash secured put on something, say a stock that looked like this was oversold, and we were potentially looking at selling a cash secured put on it, we wouldn't want to do that because the downside is technically limitless. Obviously, it's limited at 0 technically, but you can continue to lose a decent bit of cash. But the idea here is that if this thing does have another green candle and shoots up to like 50, playing it down with a credit spread is actually a great way to do this. And what we've set up here is a $3 wide spread. So we're getting a 70-cent potential max profit on a $3 wide spread, so there's 2.30 of risk. Because again, we're getting the 70-cent credit. That $3 width minus the 0.7 is 2.3 of risk. So max gain of 0.7, max loss of 2.3, meaning that there's a 30.4% return on risk for these spreads. And we've sold 3 of them, so the max gain is 210. And we're going to hit that max gain anywhere 37 and below, which is plotted right about here. So we've already seen it start to cool off a little bit. We've got a cushion, and we've got about 5 days for this thing to hopefully find a top and fall back down. Now, the idea, ideally, with all of these is that you get the move right off the bat Monday, Tuesday. You close out for like 50, 60, 70% of max profit. You never think about it again. Because, again, we saw what that chart looked like on a 1-year basis. Anything that looks like this, your strike, whether you're above it or below it, it's really never safe, quite frankly. So anytime we see the opportunity to take a profit, we definitely want to look into doing that. So if we're able to close it for like 30 cents tomorrow and it dropped back down hypothetically, that's a great trade. That's $120. You close it out on a Monday, and at the end of the week, when you're looking back and adding everything up, you say, oh yeah, I remember TGTX. That was a great trade, and we did a good job this past week. But as it stands, this is where it currently sits. Shake Shack, another one that fell into a similar category right there. And if we go to the 1 year RSI, we're looking at 74.61 right here of RSI. So it's really, really creeping up. And unfortunately, I timed this very, very poorly on Friday. If we look at the 5-day chart, I think I opened it right around here. And then before the end of the day, our cushion was kind of already spent. But the idea is, one, this thing's running into an area where there's probably going to be a little bit of resistance, right? We draw a line across it. And if we extend that line, we're seeing a level where it started to bounce off of before running back up as support. It bounced off here again, bounced off before breaking down. And anytime you break down on support and come back up into it, typically that level off the bat is going to be resistance. So that's the idea of what we're doing around this mid 60s level. So again, we sold a 65-67 call credit spread, meaning that anywhere 65-60, which is the short leg of the strike, or short leg of the spread plus the credit, anywhere 65-60 and below, we're going to make money on it. And of course, max profits below 65. So 65-60 is right about here. And it definitely ran up into it. It ran pretty hot, but we trust in RSI. And again, if it continues to move up against us even further, we have our max gain, or our max loss rather, is going to be capped. So the most this can be worth is 2, and that's if we hold it to expiry and it gets past 67. Neither of those things are really on the table yet. But again, the way that we want to think about this is we could treat it similarly, where if it starts to run to 67, we could treat it like another normal position where we double down, and all of a sudden we go from a 65-60 to maybe like 66-10 or 66-20. And then if you want to get really crazy, what I might propose is saying, hey, if it runs past 67, let's remember what a credit spread is made up of, right? There's a short leg, which is going to be the losing leg and is where our losses on paper on the trade are going to be derived from. But there's also the long leg, right? The 67 strike call that we bought to create the credit spread and cap our losses to make the trade a little safer. If Shake Shack runs up past 67, that 67 strike call is going to be profitable. So what you could actually do, and let me actually go in here, what you'll see is that, we sold the 65 strike call for 87 cents. So if I pull the calculator up again, 65 plus 0.87, if we had only sold that 65 strike call, we'd be looking at a 65.87 break-even price. But then if we close the 67 strike call for a profit of like 40 cents, we'd add 0.4, and all of a sudden we're looking at a 66.27 break-even price. Now it gets a little bit dangerous because you're into the realm of holding a naked call, but if we look at Shake Shack again on a 1-year basis, this isn't necessarily something I'm afraid is going to shoot to the moon or anything like that, or completely run off the face of the earth. And especially now that it's already in an overbought RSI position, if it runs even further, it's only going to get more and more overbought. So we scale into the short side in anticipation of it cooling off a little bit. Really kind of a similar idea to what we do on the long side of things. But that's the idea right there. And again, it's at 65.53 as of the end of the day Friday. We've got tons of time between now and Friday. We don't need to make this a dangerous trade, until we have to, right? So just hands off, let it do its thing for a few days. If we have the opportunity to take profit, take it. But that is what's going on with that Shake Shack position. Excuse me. RCL, very, very similar idea, right? It might still be on the scan. Boom, it's still on the scan right there. So if we go to RCL, what you're going to see, what's great about this one is I think technically on a 1-year basis, this chart looks a lot better. If you put a line right here at 76, the short leg of that credit spread we sold, 76.78, it lines up almost perfectly with where it got capped out back in, end of February, early March of 2023. And again, 72.86 on a 1-year basis. Last time it got up into the red, you'll see it right here. It was back in January. Gets up into the red, and there's this big red candle. Now again, it goes up a little bit after, but that's not for another week or two after that initial red candle. And that initial red candle is all we need for the opportunity to get out of our credit spread for a profit. But again, we see it start to jump up and get overbought a little bit over here. And what happens? You may have had to wait this one out a little bit longer, maybe a week or two, but it fell back down. So I'm really, really confident and comfortable using this concept of RSI. And again, this isn't one of those heavily shorted stocks. It's not hard to borrow. This is another one where if it really does start to run, I wouldn't be too upset because again, the 3-year high on this thing's 100. It's definitely not exactly set up to start sprinting away from you in a situation where a naked call would be overly dangerous. But again, at the end of the day, the credit spreads are going to be safe if you're not comfortable with that, or if your broker doesn't let you, no big deal, right? We could still manage these credit spreads effectively. That brings us to pretty much the last thing I want to talk about for the coming week, which is going to be Lyft, the 8.5 strike put here. This is a continuation of what we did on Friday, and I think a great example of how effective 0 day till expiry options are. So Lyft had earnings Thursday afternoon, and you really want to pay attention during earnings season to the Thursday afternoon, Friday morning. Sorry, for whatever reason, I can't type and talk at the same time, but you want to pay attention to the early Friday morning, late Thursday afternoon earnings windows. Why is that? The answer is because they drum up some implied volatility that you could take advantage of. Now, we know in a vacuum that after a company announces earnings, the implied volatility is going to drop off pretty steeply. We see that demonstrated pretty well right here with Lyft. However, if we go back on like a 180-day basis, it's still relatively in the neighborhood of where it's traded on a 180-day basis. And if we really, really zoom in on a 1 day basis here, what we'll see is right after open, there's still a little bit of residual implied volatility that quickly drops off. And that's really what we're trying to take advantage of right here. So the idea is after you see this big steep drop off, one, you need to be comfortable with why the stock dropped off. If the stock is dropping because the company is threatening bankruptcy or there's some sort of liquidity issue or there's going to be some other issue where they're going to cease to exist, that's what you want to avoid. But if maybe they had poor guidance or like sales figures weren't as great as you normally would expect or there wasn't great revenue growth, those are ones where we could start to get comfortable with scalping in and getting in and out quickly in a position like this. So what we did on Friday, and we'll go back to the 1 day chart, is when it was trading at about 860 after these red candles here, and again 860 right about here, we said, hey, a day objectively is a long time, but at the same time a 0 day till expiry option is beautiful when you've got this little bit of residual implied volatility before it just completely falls off the face of the earth. So what we did was we sold an 8 strike put for 17 cents of premium. Again, this is where it was trading when we entered. And we know that an 8.5 strike put selling for 17 cents is going to set us up with a 8.33 break-even price, which is down here, 8.33. So pretty damn good. And in fact, coincidentally, that was the low on the day. And if you want to talk just pure numbers, if something's trading at 8.60 and your break-even's 8.33, that's 27 cents of cushion on a stock that's trading at 8.60. You get an intraday 3.14% cushion, which is, I think, fantastic. Now, what happened was our hand got a little bit forced here when it went down to 8.33. So what we did was we rolled these things, and they got up to about 23 cents, I think, at one point, which is, we literally did this at the low. Our luck could not have been worse, because if we held till the end of the day, it would have hit max profit. But the great part about this is, even though we did get breached, and even though we didn't time it great, in fact, we quite literally timed it as poorly as you could, we're fine. Because what we did is we rolled at the same strike. And what we did is we rolled for a 3 strike, or for a 3-cent credit. So our break-even price for next week is no longer 8.33, it's now 8.30. Now the 3-cent credit, believe me, I'm with you, it's not a big number. It's not huge. But we go into next week with a slightly lower break-even price, and a little bit of flexibility, and we're in there knowing that it finished at 863. So we've got a decent cushion built in for next week. And again, if this thing finishes above 850, we've bagged $130. That washes out that $30 loss from last week pretty nicely, and that's $100 a quick profit just by scalping in that little bit of implied volatility from that earnings dip. And again, half size position, right? If it wants to go back down to 8-ish a share, we could sell 8 strike puts, hopefully for something in the neighborhood of 20-ish cents. And then get that break even down to 8.10 and just continue to work it down and down and down. Because definitely sometimes these earning moves can play out for a few different days and, kind of not necessarily be one quick move down, but 1, 2, or 3 days worth of negative price action. But again, great example here. Had we held, we would hit max profit. So objectively, this trade would have been great. But of course, even if you do the worst possible thing you could do, which is what we did, and I still think it was the smart move. Not every winning trade is the smartest trade, but I think we made the smart move. And even if that does happen and it moves this far against you, you've got the easy rollout to next week. Nice and easy. Bag yourself 130 for the following week and keep it going. So definitely keep an eye on those Thursday, Friday earners. The earnings report stocks. That was just really terribly worded. It's because we're getting to the top of the hour. But that's the strategy right there. And then XSP, of course, is our XSP Strangle. CPI is coming out Tuesday morning, 8:30 a.m. I don't know if I necessarily want to keep holding that, so I'll probably shut that one down Monday morning. But that is what we've got for the coming week, right? And again, biggest thing we want to focus on here is this 24.88% fully cash secured. And I almost want to make a chart saying, if the RSI and the S&P 500 is this level, we want to be this percent fully cash secured, etc. But when you're at 50 or above 50, we definitely want to be, at 25-ish, 30-ish, but definitely no more than 35, 40, because there's always a lot of room to move down. True FX, what's going on, man? Unfortunately, we have 11 viewers total between Twitch and YouTube, which is probably a little more my fault from being terrible on the promotional front. But one of these days, we are going to hit 30. We got up to 17 or 18, I think, at one point at the peak, but we are getting close. We're going to get there. This will be in the hands of someone soon enough. I really hope so. But yeah, there we go. That's what we've got. Let's take a little bit of a look at some more scans, because of course there's nothing wrong with this. And one idea that I think is really helpful to talk about is this idea of the long-term cash secured put. And by long-term, I'm not talking like 1 or 2 years. I'm talking like 60 days till expiry. And the way that we've been finding these, and if we go to the other, I've actually got a tab for them, IV rank CSPs. And we're doing this because often we find that when implied volatility is running up and up and up, you can have these really, really nice opportunities if you go a little bit further out of the money on these things. And if you could find a stock where implied volatility is coming up, RSI is coming down at the same time, and you're comfortable that the company isn't going to completely go under tomorrow, and the way that I evaluate that best is saying, okay, does the company have positive earnings? We had that on all 3 of these opportunities right here. So the great part about this is, for example, ABR. We found a setup like this. You go to the 1-year chart, what you're going to see on ABR, boom, you have this huge run up in implied volatility. At the same time, you have this decrease in RSI, and we were able to get in there in the low 10s. I mean, if we had bought this thing, straight up, it would have been really, really nice. However, that's okay, because if it kept dropping, we would have been fine, and that would not be the case if we bought it. But this trade lasted, I think, 3 days. This is really wrong. I don't know why this says that. We did not exit on 5/7. I need to update this because the annualized return, we exited on like 421 or something like that. The annualized return was stupid. But the idea here is if you go a little bit further out of the money, you could get a really nice return on a really low risk trade, because we sold 7.5 strike puts. You've got these red lines here from that analysis. Something really, really bad would have had to happen for it to get all the way down there. And again, that's not saying that it can't happen, which is why we don't want to size too far into these. But again, $7,100 fully cash secured. We made $100 on it in like 4 days ish. I think it was a very, very short trade. But then we could look at something like Dish or Lumen, where these have been going on a little bit longer, 26 and 19 days respectively. We take a look at Dish, and I think this is a phenomenal example because it's continued to drop on us, right? We got into Dish on 4/11/2023. What was Dish trading at on April 11th? The answer is April 11th is right here. It was trading at almost, just about $9 a share. So it's gone from $9 a share down to $7 a share. So it's dropped like 20+% on us in coming up on a month. However, if we look at what we sold here, these Dish, they're only worth 38 cents after we sold them for mid-30s. So the great part about that, we sold it for 34 cents. You can see it right there. It's only worth 37.5 cents now. So despite the fact this thing in 1 month has dropped, 25% against us, we've only lost $35 on it. And so long as it stays above 5, which we go back to this chart, we've got a decent cushion down to 5. Time is running up. That's the great part about these things, man. There's only a month left between now and that June expiry, roughly. As long as it stays above 5, we're gonna bag $340 from that one. And then Lumen, very, very similar situation, right? We've got a stock with a very similar setup. You see implied volatility really, really coming up. It was getting oversold. We scooped it near that $2 level, and it bounced off of 2 very nicely. Now, this isn't quite as large of a cushion as the other one, but with that 2-strike put, 21 cents, that's an 11.73% return objectively. Because it was a little closer, we sized the position a little bit smaller. But I think as we get more of these under our belt, we probably want to work on moving this position size a little bit higher, because I think it's working very, very well for us. And these are some nice trades. But that kind of begs the question, how do we find these? When do we want to enter into these? And the answer to me is right now, I don't think we really do. There may be one or two one-off instances where it's a good idea, but when we really want to size into these is when the market is giving us this opportunity. So if the market gets oversold or if implied volatility starts spiking up in the market, that's when we're going to want to get into those. Because as implied volatility builds in the market, implied volatility is going to be building at an individual stock level. And that's where we're going to find those opportunities. But burying the lead a little bit, let's get back to it. How do we find these things? Let's go to the IV rank scanner, right? Because the most important part of these setups, as we saw with Dish, is this blue line moving up and up and up, meaning more and more implied volatility, aka more and more option premium for us to sell. And the reason that we want to sell 60-ish days out is that these deeper out of the money options, right? Dish was trading at 9, we sold a 5 strike put. Those further out of the money options decay a little bit more rapidly in the 45 to 60 day window than other options in reference from the strike to the current price of the stock. So those out of the money options, that 45 to 60 day windows money. So 60, 65, 70 day, that's when we want to be selling these. So if we go to the scan, we're going to go to the IV rank scanner, and what we're going to find if we sort IV percentile from high to low, unfortunately there's probably going to be a lot of, did I exclude the banks? I excluded the banks. Nice. So what we're going to see here is all stocks with options, and then anything with an IV percentile of over 70. So these two up here, like FibroGen and Sarepta, what you're going to find is that with an IV percentile of 100, on a 1 year basis, they're at the highest IV percentile that we have seen yet. So if we go to FGEN, what we're going to see, boom, all-time high on implied volatility. And that is probably because you see this massive wick down to 1035. Is that even real? Maybe. That's kind of crazy. Larger point here, though. We talk about being comfortable with these deeper out of the money strikes. Something like FibroGen or Sarepta Therapeutics, these healthcare, these biotech companies, we're absolutely not comfortable with that. So those are 100% a no-go for these types of trades. Now, Catalent, this is a pharmaceutical company as well, I believe. Perrigo, I wonder if there is a way for me to put, like, industry. Boom, let's get industry in here, and then we could look at these really quickly. So yeah, what you'll see right here, biotech, pharma, healthcare, automobiles. So Fisker, this is one where you wouldn't necessarily be worried about it being biotech or being a healthcare company. But Fisker is one that I think they have some capital issues, so I wouldn't want to mess with that. Dish, boom, there's our stock right there. But again, we're getting down into the 80s here. So yes, this is good for ideas because it pulls up pretty much everything 70 and above. And you could, take a look through it if you're interested. But I really, really want to hit like 90, 95 plus. So anything down below here, I'm not that interested in. And we already know that most of this is biotech and pharma. It just kind of is what it is. Especially when the market runs up like this, you're not going to find a ton of opportunities in here. But again, that's the idea. That's how you find them. And if there were tons of these opportunities, we probably would exclusively be doing this because it's very low stress and I think high probability the way that we set some of these trades up. But with that said, another thing you may want to do, we talked about, is hey, yes, there's 31 here, but we want to be comfortable with these stocks and have some sort of bullish thesis to fall back on. And if you're selling something deep out of the money on a company and they start dropping rapidly and you look at their financials and you see, oh my goodness, this company is losing a lot of money, that's not necessarily something nice job saying necessarily twice, but that's not something I typically would be comfortable with from a bullish perspective. So the one single thing that I like to look at for these trades is the company making money? So how can I deduce that? And the answer is I intersect it with the personal scanner that says, okay, are they a profitable company? So we have 31 results here. We scan. All of a sudden, we are down to just, come on, that sentence almost flowed. We're working on this. I mean, it may be 0, but I think it's just taking its sweet time here. Come on. Really good live air for you guys. This is supposed to be a really good, like, ta-da moment, but maybe there are just none right now, which is tough to see. But anyways, if we remove that, putting that profitability scan on there is going to give you some stuff that you're comfortable with. And I know for a fact Dish was profitable. So I think this thing's just being annoying on the weekends. We'll try this one more time to see if it works. There we go. Takes you down to 7, as I tried to do a minute ago. 7 different stocks. And there you go. Dish is on there. We could sort this from high to low by implied volatility percentile. DRH, HR Block. This is one you could potentially look at. I mean, Let's just go through the list. HRB. Falling back down, implied volatility coming up on a 1 year basis, it's really high. But again, this is one where you look at the 1 year chart. You want to go to the 3 year chart as well. There's not something super steep out of the money where I'd be able to sell and feel comfortable with. I mean, maybe down at this 25-ish level. Hell, let's do the exercise. 75 days till expiry, boom, right here. We'd want to sell 25. And it's a 2.15% ROR. That's just really not that big of a number, right? We're looking at 7.3. We're looking at 11.73. We want some higher numbers than just a 2.15%. And again, 25 still isn't even the greatest level of all time on a 3 year basis. So that's one I would, try to stay away from. And the reason we don't see a ton of premium right there is because this is only 83.11. If this were 95 plus, that's when we would start to see some really nice premiums out of the money. We can go to Sirius, SIRI. Going to be a very similar story. Things falling off the face of the earth on a 1 year basis. Implied volatility is high, but not terribly high. Not ramping up the way that we've seen with something like Dish. This is what we want it to look a little bit more like, a little bit of a ramp up. But what you'll see is, it's bounced off 3.5. Would you be able to find something at 3 with a June, July expiry? And the answer is not really. At that 3 strike, you're getting 3.09% if you even get a fill, right? Because the bid-ask spread is 3 cents and 15 cents. Doesn't look very promising. You could get a 3.5 for June. That's kind of interesting, but again, that's a pretty big bid-ask spread. I don't know what you'd actually get filled at, and it's demonstrated that it could pretty easily go below 3.5. We've already seen that occur. But again, that's the idea. That's how you find them. They're not always going to be there, but a good thing when you're going through the process of scanning, saying, okay, let's try to find some trades. Let's look at overbought. Let's look at oversold. Let's look at IV rank. Those are kind of the 3 big ones that I'm looking at right now to find trades. And then we could, finish the exercise here. CLSK, Clean Spark. We could already see on a 20-day chart it was down to 238. So there's definitely some tangible downside here. Not noticeably higher than anything else, so we probably would leave that alone. But again, that's how you scan for them. They've gone really, really well so far. I would love for the opportunity to find some more of these, so I'm keeping an eye on it. Stay tuned to the Discord server, but when you see something like this where I'm referencing an IV rank cash secured put or a longer term cash secured put, that's what's going on. So with that little spiel to fill up the rest of the hour, this is what we've got. I think we've got a good setup. Go back to the full screen webcam and we'll wrap it up by saying thank you for tuning in. This has been the Hourglass Trader, where as time passes, we make money, and we'll see you guys again same time next week. And let me think about that. I should be able to do it same time next week with a little bit more cash in our account than we have right now. I'm excited about what we've got set up next week. Big thing that we want to keep an eye on is going to be CPI Tuesday morning, 8:30 a.m. Eastern time. So maybe another situation where on Monday you could take a look at your portfolio and say, hey, there's a little bit of risk here. Let's just close these things. There's nothing better than going into a potentially binary event with not a lot of risk. Now, we currently sit at 24.88% fully cash secured. I don't think that's a ton of risk. But if there is something that is overwhelmingly profitable and not even insanely, right, like 50% or greater that we could take off the table, I'll be happy to do that. Admittedly, CPI hasn't been as volatile as it's been over the last few months. So our approach of taking risk off the table really hasn't done a ton for us. But you can never be too safe, right? And we want to make sure that our down weeks look like this, not like this, right? Our approach, even if it makes us miss out on some of the weeks that look like this, as long as we're just slowly building week after week, we're going to be in a pretty good position. So with that said, hope you guys have a great week. Come talk to us in the Discord server. We're there chatting live every single day, sharing trades. And again, a lot of our successes come from trades we've added during the week, whether that's scaling into existing trades or identifying new trades and reacting to the market and taking what it gives us during the week. But that's all I've got for tonight. Thanks for tuning in, and we will see you guys again, at least live, in a week. So hope everyone has a great week.